Hello and welcome to the Treasury Tapes. I'm your host, Arya Shah, and today we have the privilege of speaking with Gina Martin Adams, who is the Global Chief Equity Strategist at Bloomberg Intelligence. With her deep expertise in portfolio strategy, technical analysis, and economic research, Gina has been a key voice in guiding investors through the ever evolving landscape of global markets. Gina, it's wonderful to have you with us today. Also, like before we jump into the key topics we have lined up for today, for you, let me provide a quick introduction to your impressive background. Gina brings to the table both the Chartered Financial Analyst, that is CFA, and a Chartered Market Technician, that is CMT designations, and has earned recognition in Institutional Investors All America Research Survey for her strategic insights in equity markets. And also, with a career spanning multiple decades and a strong foundation in both fundamental and technical analysis, she is a leading voice in global equity strategy. Let's dive into some of the critical market trends and macroeconomic factors influencing investment decisions. Here comes my first question for you. The Bloomberg World Index has seen a contraction of nearly 27% in membership over the past 3 years, reflecting a concentration of market capitalization in fewer stocks. So how do you see this impacting the risk adjusted returns for index investors, and what alternative asset allocation strategies or factor exposures could you better mitigate risks in this concentrated market environment?
Yeah, a great question. And first of all, I'll just say thank you very much for having me and for your kind introduction. Okay. So we've been talking about concentration on our team all year, really. And even going back more than a year, you could go back to the spring of 2023, where concentration risk really became a popular subject for strategists to start to analyze. It has been going on, though, for a much longer time. Over the last 2 years, of course, AI and AI-related stocks have come to the forefront as sort of driving this concentration risk. But when we do the work on the indices, and this is something we just did over the last week, we find that concentration has been rising for the better part of 10 years. And we know this because index constituents, the number of constituents by country in the global indices, whether you look at the Bloomberg World Index or you look at the MSCI's All World Index, you find that the number of stocks in each country index has been falling for the better part of 10 years. So this has been a long-term trend. What it has not done is diminish potential returns. I mean, right, obviously, we know that world equities have done very, very well. The US, which is an incredibly concentrated market now, has posted very strong returns long-term. But what it does not help is diversification. And what it does limit is the potential benefits of diversification for an index investor in particular. So to the degree that you're benchmarked to an index, as an investor, you're constrained by the number of stocks that are inside the index. So the first thing that comes to mind is you start looking outside of the index. There are obviously global, equities that are not included in the indices. They're generally less liquid equities, but they can provide a significant amount of alpha as well as risk contribution to a portfolio, depending upon what risk you're searching for. In an environment where the indices are becoming more concentrated, that naturally creates this notion that you can find some value outside of the indices. And we do even see some ETFs starting to be issued on the markets that really key in on this theme. We see, for instance, Research Affiliates just put out an ETF here in the States that looks at the companies that have been or invest in the companies that are no longer in the S&P 500 as a good example. And I think as long as this concentration risk continues to plague the market, you're going to see those investment opportunities emerge. The other way, to really think about this is to equally weight your portfolio. Obviously, a market cap weighted benchmark is going to face some degree of concentration risk. It's going to face, these constraints going forward where it's not going to provide nearly as much diversification benefit as it did in the past because of concentration risk. And so you can equally weight your portfolio and look at factors as an outlet here. And we do tend to look at markets in a lot of ways on an equally weighted basis to try to find value, because when you're analyzing markets as a whole, you're getting a distorted picture. right? A good example of this is the equal weighted index in the US, the S&P 500. The price to earnings multiple is roughly 2 turns higher when you look at the whole index than when you look at the equal weighted index or the index excluding the Magnificent Seven. And it can be a little bit more than 2 turns, depending upon what day or what time of the month you're looking at the multiple. I think that the other thing to consider is that there is just an entire world of equity investments that's private. We've seen private capital certainly evolve over the course of the last decade or so. Private equity is still a very vibrant industry and increasingly investable. So there are a lot of ways to think about mitigating the risk of concentration in the portfolio. I would say the other thing that's really happening real time is we're already seeing concentration risk diminish. We were in this very interesting period of time over the last 2 years where 100% of the earnings improvement in the S&P 500 actually came from AI related companies. So companies that could leverage the AI trend we're really at the forefront of driving earnings growth on the index. The rest of the index saw earnings growth contracting. And that started to change with the second quarter. That's created a broadening in the equity market. It's created capital flows improving for the stocks outside of the Magnificent Seven, which is already starting to naturally mitigate some of this concentration risk as those companies become more and more appealing via fundamental improvement. We would anticipate that the concentration risk that has emerged in the S&P should diminish somewhat as long as those companies do continue to show fundamental improvement.
Right. Also, on a similar note, like as you mentioned, since you mentioned, performance of passive strategies, how do you relate it with the active management of the portfolios?
Yeah, I mean, I think that at this point in time, it's a fantastic time for active management because the indices have become more concentrated.
Mhm.
You do want, as an equity investor, to focus, especially the professional investment community wants to focus quite a bit more on active strategies. We're seeing that emerge in the ETF landscape. 80% of ETF issuance so far this year is active. So we're definitely seeing even the ETF industry migrate toward more active strategies as a source of growth and a source of issuance. The investor community is naturally going in the same direction because a passive investment in these benchmarks does ultimately result in concentration risk for your portfolio. I think some people want that risk, right? Some people do want to buy the passive investment because they want the concentration in these largest of the large companies. But to the degree that that's not your mandate or your investment desire, the result is seeking elsewhere. And active managers naturally are going to find opportunities probably in deeper value industries, probably in some, fallen angels, depending upon your investment strategy, are looking for ideas outside of the Mag 7, while also most of them are holding the Mag 7 and certainly trading in that group. And trading in the biggest stocks as well. They also have some ability to change weightings and overweight some of the smaller companies, add positions in some of the smaller companies, and that's not going to be captured in the benchmark.
Right, right. Okay. Yeah, that sounds interesting. So further, like looking at the historical data from 1945 to 1981, profit declines during economic recessions were limited even with rising inflation and interest rates. Given the current economic landscape, do you expect a similar pattern to emerge where corporate earnings show reduced sensitivity to downturns? Like which sectors or factors, such as pricing power or balance sheet strength, do you think would be most influential in driving this resilience?
Yeah, it's a great question. And clearly you did your homework. We put this note out last week just talking about the influence of the economy on the earnings stream because mostly because the 2022 period was so interesting to us. In 2022, our economic models suggested we were in the depths of some form of economic recessionary experience, even though we did not experience massive job losses in the period. We saw, the ISM sentiment survey dip into negative territory beneath 50. We saw consumer sentiment just plummeting. We saw capacity utilization struggling. So it was clear to us in our economic models that we were contending with a period of economic distress. But that period of economic distress only resulted in a 13% drawdown in S&P 500 profits. That 13% drawdown is very different than past economic experiences, at least going back to 1982. You find that the average economic drawdown is well north of 20%, even in the mid-cycle correction of 2015, 2016, another period that was never characterized as recessionary, but nonetheless had recessionary characteristics. During that period, we saw the drawdown in profits of nearly 20%. So we started looking into this concept because what you find is actually inflation probably had an interesting impact on mitigating the downside for nominal earnings trends in the 2022 experience. Recall that was a period of time in which inflation accelerated markedly. It likely mitigated, in our view, the downdraft in earnings, along with the lack of job losses, of course. But it looked more like a recessionary drawdown that existed in the S&P 500 prior to 1982. When you go back to that period, your drawdowns in earnings affiliated with economic recession were all well under 20%. You had as little as 0% drawdowns affiliated with recessions in the 1950s to much smaller drawdowns affiliated with recession. And the difference between the two periods, the pre-1982 period and the post-1982 period, is pretty stark. As a matter of fact, the declines in earnings after 1982, even the smallest decline, is larger than the largest decline in earnings affiliated with economic downdrafts prior to 1982. So it's quite interesting. And we postulate that inflation played a pretty big role there. Rates also played a pretty big role. Corporate America really levered up in the 82 to 2020 time period. But also inflation played a big role as disinflation became part of the psychology. Inflation really, to the degree that we had any inflationary bursts, they were very rarely supply-based inflationary concerns and more demand-based. And we could be moving into a more macro environmental sort of state that looks much more like the pre-82 period, in which economic downdrafts may be vicious, but their impact on earnings may be quite different. So we want to look at companies and industries that do have some degree of pricing power, that tend to benefit from inflationary outbursts or are sheltered from inflationary changes. And I think that this is going to be a longer term secular trend that probably develops. Many people push back on this because they say it's all about rates, but we also have seen a behavioral shift in terms of corporate trends and corporate utilization of debt since the pandemic. As interest rates have risen, we've seen debt issuance trends slow materially. So we could be in for a new realm of experience with respect to earnings impacts of economic recessions if we see behavioral changes emerge for the consumer, or behavioral changes emerge with respect to inflation, and we see debt utilization trends shift. I would anticipate that earnings drawdowns are more limited, but also that economic volatility, that inflation volatility that accompanies such an environment could be pretty detrimental to certain industries. It generally means higher quality, higher margin, more services-oriented companies in non-discretionary groups should generally hold pricing power and generally perform better than their counterparts that are more levered to economic conditions, are selling products and services that are much more sensitive to changes in inflation landscape, much more discretionary in nature. So it does create an interesting investment theme that could endure through the whole next cycle, in our view.
Okay, right. Okay. And like coming to US debt dynamics and monetary policy, the US debt service ratio is at its lowest level since 1980, except during the pandemic, with debt to disposable income also below, historical averages. So, what implications do these favorable debt metrics have for have for the Federal Reserve's monetary policy stance, especially in the context of recent labor market data and inflationary pressures? Like, could this potentially shift the Fed towards a more, dovish approach, or are there still significant risks or further tightening?
Yep. So the stats that you just spoke about are with respect to the US household sector specifically. The household sector's debt service ratios are very, very low, debt to income well below former peak levels reached back in 2007, 2008. And the US household sector is in better condition financially than we've seen in a very long time. Even the lowest income households experienced increases in wealth in the trailing 3-year period. And across the income spectrum of households, we saw improved debt service ratios and improved wealth conditions over the course of the last 3 years. So the household is in generally very, very good shape on account of the fact that interest rates were so low during the pandemic, to the degree that households were exposed to interest rates, able to recapitalize their debts. So I think that that's one story that is definitely impacting the outlook for demand. We see that through much more persistent demand conditions and sort of steady consumer spending than I think many people had anticipated.
Mm-hmm.
It allowed the Fed to increase interest rates to the highest levels we've seen in years and increase very, very quickly to try to combat inflation without having a detrimental impact on overall demand conditions.
Right.
Now, this contrasts quite heavily with government debt levels, which are obviously very, very high relative to revenues. There are a lot of folks here in the States that are very concerned about the deficit and what it may mean ultimately for crowding out private sector borrowers over the course of the next decade or two, as the government has only levered up while the household has delevered over the last 10 years. So it creates complications, is the short answer for the Fed.
Yeah.
Demand does appear to be somewhat stickier, and that is exhibited through sort of consumer spending numbers, despite some wobbly housing market data, some wobbly employment data. The consumer has held in relatively strong over the course of the last few years, even with sentiment at all-time lows back in 2022 and some concerns about inflation. The consumer is still spending. And that creates a difficult environment for the Fed in that they can only reduce interest rates so far without potentially igniting another path of spending burst and another potential inflationary burst around the corner. On the offset to that is, of course, government spending, which is increasingly helping to support demand, but also creating this dynamic where the government debt levels are becoming so bloated. It's very difficult for the government in the long term to contend with higher interest rates to pay back the debt. In theory, that should not be part of the Fed's concern. They really do have a mandate of trying to sustain steady economic growth while containing inflation.
Mm-hmm.
And so they'll most likely focus more on the household. But to see how this bloated government debt story sort of plays out over the next couple of years and into the next decade, I think there are going to be some periods of time in which markets are forced to deal with some indigestion around how does the government service this debt? How does the government ultimately contain this debt load and continue to remain highly operational? We have, threats of a government shutdown is something we deal with in the United States now every couple of years, at the very least. We're going to have another one come the next few months. So we're going to have to talk about this repeatedly as we deal with this sort of bloated federal deficit, the bloated debt that we have built up in trying to shelter the economy from the pandemic distress. So it does make the Fed's challenge pretty interesting. In the short term, it's pretty clear that the Fed is signaling that they will reduce interest rates as they feel that, at least in the short run, they've got inflation under control. In the longer term, I think there's some suspicion as to just how much they can reduce interest rates. And certainly very few people think they can go back to all-time low levels of interest rates because of these unique economic conditions that we have in play right now.
Yeah. Yeah, that's an interesting take on that. Also, like we have upcoming US presidential election coming up this year, and the potential for majority policy changes. How, with the potential of major policy changes, how do you assess the market's current pricing of election-related
Yeah.
risks, as in, like particularly in sectors that are heavily regulated, like technology, energy, or
Yeah.
healthcare? Like, what are the potential impacts of different electoral outcomes of capital flows,
Yeah.
corporate earnings, and overall sector performance?
Sure. There are multiple scenarios that could still play out. And given the fact that the race here in the United States is virtually 50-50, and very few people have high conviction that one candidate or another is going to win this election. So it's so far is somewhat uninvestable. It's very difficult to put capital to work based upon an election theme or a presumed policy outcome of one candidate winning the White House or another when the race is 50-50. And we see this very clearly through the most tax advantaged versus the highest tax paying companies in the S&P 500. There has been pretty much no change in the trend for these companies. If there's one sort of policy lever that is very different between these two candidates, it's tax policy. One candidate very much preferring to reduce taxes, the other candidate very much preferring to increase taxes on corporates. Does appear to be one big policy divergence. And yet we've seen no change in the direction of company price performance or stock price performance based upon how much the company pays in taxes. You would anticipate those sorts of moves to emerge probably post-election.
Okay.
I think many a career and many millions of dollars have been lost trying to play election odds in advance of elections. And we saw this most profoundly in 2016 when it was generally a popularly accepted view that Hillary was going to win that election. Even companies that had high conviction that Trump was going to win the election really had a hard time predicting what the market would do after that election. And so one of the things that we talk a lot about with our clients is, sure, we want to identify companies that may be at risk or may benefit from potential policy change going into 2025.
Yeah.
But given the incredible uncertainty with respect to who may win, and even more uncertainty with respect to who may ultimately end up in Congress, it's very difficult to play the election as a tradable opportunity right now. Come 2025, there may be tradable opportunities that emerge once we have resolution of the election results. We know who's in Congress, and we get a much better sense of our new president's platform and where policies may progress over the course of that year. But it's just far too early. And I think you're seeing that play out in markets. It's just not impacting equity prices materially at this point in time.
Right. Yeah. That sounds interesting. And Gina, this has been an exceptionally insightful conversation with you today. And thank you for sharing your expertise with us. And of course, like, it's been a pleasure having you on the show. And to our listeners, thank you for tuning in. I'm Arya Shah and encourage you to stay engaged and keep exploring the evolving world of finance. Until next time.